Reports on housing going live on another Thursday at 3:00 p.m. A lot's gone on. I was actually going to talk about foreclosures, but I'll have to hold off on that because the Federal Reserve came out and spoke yesterday and answered a lot of questions. So I just had to bring it. I had to bring the latest and greatest when I saw it. So I'm going to go ahead and dive right on in. And here we are, the housing debrief. I'm inviting everybody to like and subscribe to my channel on YouTube. Go to Reports on Housing on YouTube and smash that like button. The more that you smash the like button, the more that the algorithms, YouTube algorithms like it, and we get in front of more people so that we can disseminate the most accurate information that we're seeing within the housing market, specifically here in Southern California and along the West Coast, because I have a lot of data for many West Coast markets as well. So I'm inviting you to do that. So let's get right into the Fed's squeeze on housing. And the inflation has been out of control, as you can see. To have year over year, even though it's come down a little bit on the top end, but core CPI actually has risen recently, even though gas has come down. So it's been a really big concern, and this is like year over year. We're seeing like core CPI above 7%. And that's just way too high. And so the Fed has come out and they're battling inflation with all the tools they possibly have. They come together, like I believe it's like every 6 weeks. And then the last time that they did a big change was back in June. And then they're meeting again this week and pulled the trigger on something. And they came out pretty much out of Jackson Hole, Wyoming. And prior to that, a lot of the Fed chairs were getting up and they were speaking, and they were coming out with like guns blazing, and they were ready to go to battle with inflation and telling everybody that we're not going to back down. That was the way that they were coming across. The markets were trying to understand how real this was, if they would really continue, if they would pivot down the road when they saw some more pain that they caused. And sure enough, they mentioned it over and over again. And this was coming out of Jackson Hole. That 8-minute speech talked a lot about pain for households, pain for businesses. They're going to do everything they possibly can to tamper down inflation, because they would rather get inflation under controls with these short-term pain over like the next couple of years, and so that we don't have the pain of this wage price spiral and inflation going out of control. And every you might be making more money, but now you're losing more money because you're spending it on more expensive goods and services. So yesterday they've been meeting over the last couple of days, and yesterday they announced that the Fed will raise the short-term rate 0.75 of a point, so 0.75 basis points. And what they're trying to do is really slow down the demand side of the economy. And they're going to do it until something breaks. Basically, they're looking at job openings. They want to see that job openings come down. Right now, there's 2 jobs for every 1 person looking. That's out of balance. They want to see that the supply of jobs comes down more in line with the number of people that are unemployed. So they're watching unemployment very closely as well, along with job openings. And then, of course, there is consumer spending. I better go like this so that you can properly see my slides. So consumer spending. And consumer spending right now is still way too hot. They want to see that people start contracting a little bit in spending, and that will, of course, cause fewer job openings and more unemployment along the way. So they're kind of waiting until something cracks. And I've heard some people say it'll crack sometime this year, maybe in December, but we'll still have to wait and see as to when this comes, because that's when we're going to start to probably see this recession that everybody is talking about a little deeper than this like technical recession for the first 2 quarters of this year. I really, at this point, and a lot of investors are getting it, that the Fed is not going to roll over as soon as there's a lot of pain. They're really coming out and they're showing that, you know what, we've got this, and we're going to continue to fight the battle. As a matter of fact, the Federal Reserve Chair, this is Jerome Powell, has a book on his desk. And the book is from Paul Volcker, and it's called Keeping at It. And as a matter of fact, in his Jackson Hole, Wyoming speech, he said, we're going to keep at it. We're going to keep at it. He said it several different times within that speech. And he's referencing Paul Volcker. he really thinks that you have to have a firm backbone and do what it takes to bring down inflation and not pivot like so many people are thinking that they'll do. I still don't know if that pivot is coming because, you know what, it's really easy to say all this until there's a tremendous pressure politically and from constituents and everybody across the United States when people are hurting. We'll see what happens down the road. It's very easy for them to say that right now. So, but they had a speech. Jerome Powell, after they met, did the announcement, said that it's going to go up 0.75 of a point, as just about everybody had already come to that conclusion prior. And he basically was asked a question after he did his speech. It was the Q&A. Second to last question was from, I believe it was a reporter from CNN, and she asked, so when you brought up in June this reset in the housing market, what did you mean by the reset in the housing market? And basically, and this is going to be a lot of text, but it's very important because he said a lot about housing. And if you have any interest in housing, we need to know what their stance is from the Federal Reserve standpoint. Because yeah, they talked about housing reset, but we were all scratching our head going, well, exactly what do you mean by that? And so basically what he has said is, so when I say reset, I'm not looking at a particular specific set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country where, you know, famously houses were selling to the first buyer at 10% above the ask before even seeing the house. Now, of course, that's a bit of an exaggeration, but you get it. It was way too, prices were going up and it was way too unhealthy. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we are seeing should help bring prices more closely in line with rents and other housing market fundamentals. This is where it gets a little juicy, he said, and that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. So we probably in the housing market need to go through a correction to get back to that place. From a business cycle standpoint, this difficult correction should put the housing market back into better balance. I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. It may take some time, and very accurate. So I'm, after digesting it all, wondering specifically what tools does he have to really bring, to forcefully bring about a correction in housing. And in looking at everything, I don't know if he has the complete picture. What he has is this ability to ratchet up the short-term rate, which ultimately ratchets up the long-term rate. And with higher rates is expecting there to be more inventory, and with more inventory and less demand, prices fall. But there is an issue at hand, and we kind of talked about it many times before, and we'll get into that in a minute. But I've done the math. I have done the math, looked at it and going, gosh, what is it that he's talking about that the Fed controls, that it gives them the ability to properly slow down the housing market and for it to correct? So, but first, I'd like to thank our sponsor with Jason Thibodeau, JMJ Financial. He's been sponsoring us for a while. We really appreciate it. I've seen Jason at many different events recently. You can contact him at 714-330-8263. They have an earnest money EMD protection program. It's the earnest money deposit in your insurance. It's making sure that you have that you get your earnest money deposit if you were to back out of a transaction. It costs about just under $2,000, but you get it back once your loan funds. So there's that kind of a program. There's a lock and shop mortgage, which, boy, to definitely understand why at times you want to lock and shop, because yesterday rates went down for a minute, and that's when I was thinking, gosh, you might want to lock in the situation. And sure enough, that's what happened today. Rates went up. 2-1 buy down mortgage. This is the ability for sellers, if they have, or if a buyer is negotiating and wants, you know what, we're a little bit further apart, perhaps you can pay some points, this 2-1 buy down, and get me a better rate for a while. That's out there as well. So you don't So these sellers don't have to do giant reductions. They can actually pay for these buy downs, and that's a big help. It's just another negotiating tool as well. So their methodology is simple. We don't mess as we can't keep. So contact Jason Thibodeau at JMJ Financial at 714-330-8263. That's 714-330-8263. Again, thank you for your sponsorship, Jason. We really appreciate it. Now back to the program. We were talking about looking at how in the world they can affect it when they can't add a bunch of supply. They could definitely diminish the demand side, which we're seeing right now today over what's happened over the last couple of weeks. I'm seeing a little bit of a change in demand, and I'll show that at the very, very end. The federal funds rate is what they control. That's actually the short-term rate. That's where they control credit card debt, equity line of credit, automobile loans. It's the short-term debt that the side of things that they can control. However, there is a link with long-term, but it's not necessarily this one-to-one. Matter of fact, when the federal funds rate went up 0.75 of a point yesterday, we saw a little bit of a reprieve in 30-year mortgage rates for a short period of time. And then along came this morning. So they have done everything in their power, the tools that they have, and they're trying everything to properly slow down the economy until something breaks. They're coming out in full force. They definitely want to talk this up and make sure that everybody's on the same page, that they are trying to front load this. They're trying because it takes a while after they do these short-term rates for them to evolve into the system. However, when they're coming out, their guns blazing and talking about it all the time, and all the different Fed presidents of the different areas, they're coming out and they're also talking about it like crazy. They're trying to make sure that it's going down the path that they want to see. As a matter of fact, they did not like to see the Wall Street doing well in the month of August, as well as they did not like seeing interest rates fall from 6% in June down to 5% at the beginning of August. So as a matter of fact, then they started saying everything they possibly could, went into Jackson Hole, changed things up, and now you can see Wall Street is behaving like, there's something going on. They were really serious, as well as we've seen mortgage rates go up. Mortgage rates have definitely been on the rise, and they can influence mortgage rates by what they're going to do in the future. As a matter of fact, at the very beginning of this year, they hadn't touched mortgage rates. They hadn't done anything, yet interest rates were rising all the way from January to March when they first started. They brought down their Fed funds rate. They increased their Fed funds rate, that short-term rate. They started draining the balance sheet, and they also stopped buying mortgage-backed securities. They had brought that down to no brand new ones that they were purchasing. So know that they were doing all three of those at the same time. So starting in March, but we had interest rates already going up because the general market understood what the game plan was, and then they made moves based upon that. And that's the appetite to buy 10-year treasuries and mortgage-backed securities. And now the private sector has to buy mortgage-backed securities. It's no longer the Federal Reserve propping it up. So this is the plot maps. These are the plot maps telling us where they believe, these are all the different chairs, where the presidents, where they believe the short-term rate should be going off into the future. And you can see where they think they should be in 2022. And this was back in June. Now I'm showing you this because these are different ranges. They say between 4 and 4.25. The highest that they had, which you could see in the very middle, way over here, is 4.25 to 4.5. There was one person that said that. Now that was for 2023, and you could see here at the end of 2022, they believed that they needed to be between 3.75 and 4. There was only one person. Now, flash forward to today, and you see all of a sudden, this was yesterday's plot map, and everybody is suddenly on board with between, they want to be between 4.25 and 4.5 and 4.5, and 4.25 and 4 and 4.25 and 4.25 and 4.5. There's even one person that wants to be between 4.5 and 4.75. So, and then in 2023, and this is what I was talking about. Now that's in 2022. Now in 2023, they even see it going higher. And this is higher than where we were before. in June where they thought they were going to be. Now they're saying this is the course that we're mapping out, and they're saying higher than what we thought. Now the overall market has to absorb this new game plan that the Federal Reserve is now selecting. They're saying, okay, we're thinking we're going to go here, and now, and as of yesterday, they're saying, no, we want to go up here. And that is a big, giant change. And then there's plot map, there's dots to the right of that 2024, and they added 2025, and they have no clue where they want to be yet. There's a lot of charts and data before they even get there. So interest rates have been rising, and they rose from 3.25% to 6.47% prior to the Fed meeting. And that was as of yesterday morning, we were at 6.47%. So we started off the year at 3.25%. Now, the 10-year Treasury is the same appetite for 30-year mortgage-backed securities, pretty much the same investor. It's not totally one-to-one what it does, but there's a definite stickiness. When 10-year Treasury goes up, so do 30-year mortgages. When 10-year Treasury goes down, so do 30-year mortgages. That's why we follow it. And you can see what's happened since they bottomed out in August at that 5% level. The 10-year Treasury also bottomed out well below 3%, and ever since then was continuing to go up through Jackson Hole and then spiked over the last several days. And as a matter of fact, this goes right in line with that. So at the beginning of the year, January, we were already digesting the fact what the Federal Reserve is going to do, and you could see interest rates were continuing to go up. So there it is. It continues to go up all the way until we got to July. Then we got up to 6.28%. And then after that was when we had a really hot CPI. It was hotter than expected. But then after that, it was digested, and pretty much the rates started to come down until they bottomed out in August. And then in August, they started to go up again. And then they were going to meet at Jackson Hole. They were all talking over and over again. All the different Fed chairs were talking as much as they possibly could. And you could see rise is what it did. It kept on rising. It surpassed where it was in June, and it's hit new highs. And where it is as of today, so it went down. It went down yesterday. So from 6.42, I can't remember exactly where it went down to, but it went down a little bit. And from that little bit that it went down, it then just surged today. The 10-year Treasury went up like crazy, and so did 30-year mortgages. We're now at 6.62%. Now, this changes everybody's model, including my model and everybody else's, because we were expecting them to go one direction. Now they just said that we're going to have to even go higher than what we thought. So because of that, it changes where we think that these 30-year mortgages will lie. So as you can see, at 6.62%, we're kind of up there. We're making our way towards 7%, which is making unaffordability of housing. If you thought it was unaffordable at 6.62%, it is even more unaffordable. So it is adding a little bit gasoline to that unaffordability metric. And the last time we were at 6.62%, I had to dial it back. It was all the way back to July of 2007 was the last time that we had an interest rate at 6.62%. So we were at 2008 levels, but now we've hit 2007 levels. That's how far back it goes before the last time we saw 6.62%. And so as far as the housing market's concerned and everything that's going on in here, this is where there's this tug of war between supply and demand, and people are going, how in the world? Now, with prices, with unaffordability being such a giant, it's such a big piece of the market where homes are so unaffordable at this point that we're starting to get a lot of pressure on pricing. However, that pressure is being it can't come down like a lot of people think that it will, like crash down like it did during the Great Recession. Instead, it's only going to be slightly that it can even go down right now because there's just not enough product. There's not enough homes available. So the lack of inventory is kind of keeping the market up where it's at. But there's still even more pressure that's mounting up top because interest rates continue to rise. But there's this tug of war between buyers and sellers because this is low supply and this low demand. And because of that, they're kind of like tugging away, and there's not a lot of movement as far as prices are concerned, if you can kind of grasp that concept. Because I have talked about the supply crisis before. We're definitely way below where we were prior to COVID. On September 15th, last Thursday, it was at 30,000. It actually had gone up 0.5% in a 2-week period of time. Last year, we were at 20,181. That is 33% less. and that was the all-time low. And the 3-year average prior to COVID is 41,000. So we should basically, that's 36% higher than where we are today. We should have a lot more homes in order for us to get to where we were prior to COVID. So we're still dealing with a very, very muted inventory, not just here in Southern California, in all markets across the United States. It's not all markets, but it's overall United States, because there are certain areas that are having more of an issue, like Boise and Austin, some of those ultra hot areas. And then today we're at 30,267. So really it did not come down much. It's really kind of flat. We were coming down, but that ability to come down has been muted because interest rates continue to rise and demand continue to fall. So it's not eating into the existing inventory that's coming on, even though the existing inventory that's coming on has been muted as well. So this low demand thing that we're talking about, you can see it in the demand. This is a snapshot of the last 30 days worth of escrow activity. On last Thursday was 12,101. It went down 3%, or down nearly 400 pending sales in a 2-week period of time. Last year, we had 50% more escrows at this time for a 30-day period. The 3-year average is 15,696, which is 26% higher than where we are today. So you get it. Muted demand, muted number of escrows compared to a muted inventory. And today I snapped the numbers. We'll see exactly where it is by tonight. But right now, as of right this moment, it's at 11,563, which is down 4% compared to last Thursday. So from Thursday went down another 4%. This has everything to do with the fact that interest rates are going up even more, and there could be some escrows that are canceled. So know that there might be some people that are a bit skittish, and the cancellation rates have been a little bit higher. The speed of the market, on September 15th, we were at 75 days. Last Thursday, that was up 3 days in a 2-week period of time. So we were at 72, and now it's at 75 days as of last Thursday. Last year, we were at 33 days at the same period of time. And the 3-year average prior to COVID is at 81 days. So that's where we are, right where we were prior to COVID. But in 2007, we were at a 200+ day expected market time. And I just wanted to throw that out there so you understood where we're at today. Today, we're at 79 days. That is up 4 from last Thursday. So we've gone up since last Thursday, and another 4 days. So things have slowed down a little bit, and that's only because of the fact that we are dealing with higher interest rates, which has diminished demand a little bit more and has not allowed the inventory to fall like it had been falling prior. But I do want to explain one thing. There is this thing called hunkering down. The higher interest rates get, the more inclined people are to stay in their homes. The reason for that is 72% of all homeowners with a mortgage have a mortgage rate of 4% or lower. And for all of Southern California, it is off by 24%. In the month of August. You can see that on the right-hand side. Right over here on the right-hand side, you can see we're off by 24%. The number of homes coming on the market compared to when things were normal prior to COVID, 2017, 18, and 19. It is missing almost a quarter of what normally comes on the market. So that has enabled the inventory to stay flat and not really go up. It should have continued to go up, even though it typically peaks in the summer, but it should have continued to go up all the way until it peaked in October, right prior to the holidays. But instead, with this muted supply coming on, it has really affected the supply channels, and we're going to soon see the inventory start to drop a little bit. But we'll also have to watch where interest rates go, because this is a very progressive economic model that we are dealing with. It's progressing on a daily, weekly basis. So, but you can see for the whole entire year, we're actually placing fewer homes on the market compared to the averages prior to COVID. And that has, even though we've had these extra higher rates, because there's been fewer homes that have come on the market, the buyers that are looking around don't have as many to choose from. And it's eating into that existing inventory, and it hasn't allowed it to build like I originally thought we were going to be able to build an inventory and get more towards a buyer's market. So, and know that what the Federal Reserve is saying is they don't know when this this correction that they're talking about with housing is going to happen. And from everything that I'm looking at, and that trend of hunkering down as well added into the mix, you can throw interest rates up and make them higher and higher and higher, but it's really going to make homeowners hunker down even more. So when all of that happens, it's going to create something that takes a while before they see that correction that they're looking for. Can we see home values go down? Well, that's what I'm prognosticating to happen in 2023, but just not at the rate that people are thinking. It will come down slightly, but in the single digits. And I think Ivy, she's a Wall Street guru in housing, also said something very similar, that we can see single digit depreciation in housing. And I'm now seeing where we can get that. And we'll just have to see how everything plays from here on out. Is our interest rates going to continue to make their way towards 7, or are they going to come back down? And when the Fed meets down the road, where are their dots going to lie down the road? Because they really want to get a handle on this inflation. So with that said, oops, that's funny, Q&A. But I'll answer any questions you have in the chat. I'll do this after we go offline. If you want a copy of this, you need to be a subscriber to the Housing Report, reportsonhousing.com. That's where you go to subscribe. And we have reports that dot all over SoCal and soon the Bay Area as well. It's $15 per month or $150 per year. You get the first month free if you sign up. If you sign up right now today. And the most recent one, when you sign up, it's called Hunkering Down. I explain what I mean by hunkering down and what I'm seeing in the numbers in each of the 5 different counties. San Bernardino Riverside actually gets theirs this coming up Monday. And if you want a free month, go here. This is it. It's the coupon. Fed 2022 is the coupon you can use. Fed 2022. You can use that QR code. That'll take you right to where you need to be to go ahead and subscribe. You too can become a subscriber. And I will tell you what I am seeing in the tea leaves at every given moment. I'm not going to say where I think things are going to go. I'm not going to project my narrative. I'm going to tell you where we're going. And based upon what we see and the facts and data that we have, where are we going? That's our economic model. But I do think I have a special guest. Where's my special guest? Oh, I do have one. Here she is. Let me go ahead and she. I thought it was your sister.
No.
She always sneaks up from behind me, right behind my chair. So there it is. Who's this?
Mason Thomas.
Mason Thomas. So what do you want to be when you grow up?
Engineer.
Engineer. Sounds like he might be an economist. We'll have to see. But he wants to be an engineer because he's really good with his hands, loves cars, loves taking apart things, putting things back together again. I didn't do that when I was younger, so it's probably going to be an engineer. You do whatever you want. Right on. Yep. Boom. Anyways, thank you for joining us. We appreciate it. Have a fantastic first day of fall. Excuse me. My brain is all twisted up. First day of fall. That's today. First day of fall. So enjoy your first day of fall. These evenings are nice. I know it's a little warm outside, but when it gets down to 60, I can take this warm weather, right? At least it's not 100 degrees at night. So have a fantastic finish your week. We will see you.